Smart Finance from the year 2005 to till date. So in this regard, this particular program is being scheduled, and yesterday I have taken three concepts. So I have given you the presentation. However, mathematical calculations, it has a detailed mathematical calculations. I have not gone to that calculation part. I have just told, I brushed off those calculations and I have told that how you should make use of that methods. So that is what I have attended. So here three concepts yesterday I have taken, and I have told you how you can make use of that. And today I am going to take two pair trade concept. So one beta decoupling concept, which we have innovated in the year 2005-6, and another Z score which has come in the 2020. So these are the two unique concept of pair trade, and very beautiful concept. It has the ability to give you excellent return if you implement it properly and follow a proper discipline. It has a great track record. Those who have utilized it, they have got immense benefit out of that. So I'll just cross up the techniques used here. How you should initiate this trade also I will tell you. And these are the very scientifically proven techniques. So here you are studying the demand and the supply scenario in a market mathematically. So if someone says that now majority of the people are selling State Bank of India or buying State Bank of India, so that you can able to tell using the beta decoupling and Z score. So here distributions whatever distribution happens, that particular distribution concepts you will be learning through this method. So this is a very important method. And before I should go to the method, yesterday due to lack of time I could not able to complete the smart finance products and service part. So here if you go to our website, go to the products link, here all our products displays here. So we have very unique kind of courses, 6 to 7 different courses, and those concepts are being programmed in softwares. So softwares are decision process softwares. It will help you so in taking decisions. So whatever the calculation you can do in Excel or manually, software will do it, and you will get that entire result of the software. So that also you are going to see today. So these are the 6 to 7 different softwares we have. Same concepts we explained in the courses. Courses are for the people, those who want to learn this concept, how this calculation happens, for that. And those who don't want to learn, just simply wants to use it, they can take the software. So the price tags are displayed here. And if you go for entire package, all software, all courses, there also you enjoy a great discount. And time to time we conduct various webinars. Our upcoming webinar is going to happen on 16th September to 24th September. 70 people have registered for that, and this is on advanced WD GAN concept. So here many advanced concept of WD GAN I am going to discuss. So maybe many of you will be knowing about square of 9, but WD GAN method doesn't start and end with the square of 9. Many advanced concepts are there. So GAN's vibration number, how you can use it, tetrahedron, square of 144, which is Jupiter cycle, universal formula for converting degree to time. All these things is going to be discussed here. So we have opened up the window for registration. So post this 100 registrations, the fee will be revised. So we are going to increase the fee. First initially it is being kept for 50. Now we have revised it to 100. Post 100 registrations, the fee will be revised. So if you want, you can register for that as early as possible. So this is some early offers we used to give, so that those who are our loyal customers, loyal clients, they should get one opportunity to join such kind of events. So I'll be going to now to the subject. Once again, good evening to all of you, and this is a great method you are going to experience today, beta decoupling method and z-score method. So what is beta decoupling and what is z-score? So all of you will be knowing that there is a concept called beta. So you can say that high beta stock, low beta stock. So that is what is being pictured everywhere. So when you say that high beta stock, if market or index gives 1% return, the high beta stock will be giving greater than 1%. So this is what it says. So if the beta of the stock is 1.5, so you can say if index is giving you 1% return, then that particular stock will give you 1.5% return. So there only our knowledge stops there. So majority of the people think beta has this limited role. However, beta having a broad role, it's having a huge role, but we have just understood beta. High beta stock means 1% gain in index will give greater than 1% return in that particular stock. Low beta stock means it will give less than the return produced by the index. However, beta decoupling is a method we have invented in the year of 2005, and believe me, it has made many HNI traders, high net worth traders, the traders, those who have started with a few lakhs, 3 to 5 lakhs or 10 lakhs on that particular time, I'm talking a year of 2005, they are now sitting with crore plus capital by using this technique. Just imagine what kind of potentiality this technique has. So here I'll not go deep into the subject, so that is more mathematical, it requires a lot of things here. So what this beta decoupling says, every stock or index is having a beta, and that stock is not compulsorily follow that beta, it will deviate every day. So every stock is having a beta, so but that beta will change every day. So what is beta? So when you say beta, what is beta? What is z score? Beta is nothing but the relationship between both. It is just like the competitiveness between both. Suppose if I am saying that Bank Nifty and Nifty, what is the competitiveness between them? So if one runs one step, how many steps the other will run? That is called your beta in classical definition. In literal definition, if I say what is beta, then you will say that okay, between your friend and you there is a beta of 1.5. That means in a morning walk, if your friend walks 10 steps, same time you will walk 15 steps. So that is your beta. So beta is just a mathematical competitiveness between these two stocks. So this competitive nature changes every time, every day, every minute, every day, and it will change. So that deviation or that non-matching competitiveness is known as your decoupling. It is expected to move this much, it has moved lesser than that. That is called decoupling. And this lesser than accumulates and finally gives you a figure or creates an opportunity where you should buy or sell. So two stocks will be involved here. So in beta, we'll have one independent parameter, one dependent parameter. Who will be independent? The stock or index having the higher volatility will be independent. Stock or stock having lower volatility will have dependent. So here there is a rule we have fixed. This is my own method. This is my own innovation. You are learning from me, because this concept is nowhere in the book. It is being innovated by me, and it is pictured only in my book, Master's Key to Futures and Options. So this my book only pictures this thing. This is my own concept. This is only, you can say, this is my only copyrighted concept, or all my concepts are copyrighted, so patented, you can say. So this is my concept only. So here independent means the stock or the indices having higher volatility is independent. So he is having higher volatility, higher energy, higher risk. So he is independent. Which is having lower volatility is dependent. So the position also will change. Someone is dependent now can become independent afterwards. Someone is independent can become dependent also. So by this process, when the beta comes to negative -1 to -2, that is the time you should buy the dependent, sell the independent. How much value? Both values sell. 1 lakh purchase means 1 lakh sell. That is what you should do. So buy the independent means positive beta decoupling, buy the independent. So this is the process, simple process. It looks simple, but implementation is little difficult. It is not that easy. So what we are going to do, suppose Bank Nifty and Nifty I have taken in beta decoupling method, I will be taking 3 calendar month. Very carefully listen. 3 calendar month. Nifty and Bank Nifty. I am in the month of August. So I'll be taking 3 calendar month. So whenever August will end, I'll go to the September. However, the June will move here. June data will totally go out. July, August and September will come. So two are the complete month, one will be the running month. Then we'll be taking their prices. What is the everyday closing prices we will take, and what is the percentage of changes, negative percentage or positive percentage we will take. So this has moved 0.33% positive. Nifty has the same day moved 0.25% positive. So like this way, every day change in the percentage will take. Post that, we have to calculate the beta. So beta is covariance divided by variance into n divided by n minus 1. So 10 period beta we have to calculate. 10 period, 10 days beta we have to calculate on percentage terms. Why we are not taking the price? Price is 43,000, 18,000. So both are having a great difference. One is 2.5 times more than the price. So we want a normalization. We are not bothered about that number 43,000, 18,000, 19,000, 20,000. We are no more bothered about that numbers. We want whatever may be the number, how much percentage of oscillation every day they have given. Then using the covariance divided by variance. So beta formula is nothing but covariance of x and y. X is independent, y is dependent. So divided by variance of x, variance of x, variance of x. So this factor need to be multiplied with 10 divided by 9, because 10 days or 10 period we are taking. This is how we will be finding out the beta. So this beta, what it speaks? So we have calculated beta. So what does it mean? On that particular day, that means on 14th of June, it is telling beta is 0.85%. So very carefully look at this figure. Beta is 0.85%. Whatever formula happened that you can get in internet, everything you will get. On 14th June, we are getting beta as 0.85%. That says if Bank Nifty goes up by 1% plus, Nifty will go 0.85% plus. That is what the beta says. If it goes negative -1, this also will come to minus 0.85. This is what the beta says. Competitiveness between both Bank Nifty and Nifty. It is a competitive parameter. So what happened that day? Bank Nifty fallen by 0.20. So as per beta, so this 0.20 if we'll multiply with beta, so we are expecting minus 0.1785 should come in the Nifty. However, Nifty violated that. Nifty said that why it is a mathematical parameter, why should I obey? So Nifty has told positive. We expected negative 0.17. Nifty gone positive 212. So how much it has decoupled? So this 0.212 minus our expected. So there is a decoupling, positive decoupling of 0.39 excess move happened in the Nifty. Nifty, which was expected as per beta to react and move negative by 0.17%, has moved positive by 0.21%. Hence, the decoupling it has created is 0.39. So this decoupling has created. Once this decoupling created, so next day also we'll see how much decoupling creating. So every day some or other decoupling will go on creating. So we'll go on adding every day. We have taken for 3 months. So we'll go on adding this decoupling every day basis. Sometime decoupling less, sometime more. So this addition of decoupling will continue. So one point of time, this addition of decoupling will give a value more than 2 or 1 to 2. Better is 2 plus 2 or minus 2. So here it has given on 11th July. If I take all readings, so on 11th July, it has given a value which is more than 2.48. I am summing up every day's decoupling 2.48. That means Bank Nifty and Nifty, whenever we are making these things, Nifty has moved 2.48 steps ahead of the Bank Nifty. Nifty positive. Positive means the dependent has moved faster. Independent has moved lesser. Having higher volatility as compared to the Nifty, but it has traveled less. Though it has a higher volatility, but it has moved less. 2.48 steps it has gone above or ahead. So that is the time we should enter a trade. Since it has moved ahead, so it is costlier, we'll sell and we'll buy the Bank Nifty. How much quantity? So based on the lot size, if we are going for if we are going for 3 lots, we can Bank Nifty we can buy, and sometimes 2 lots of Nifty we can sell. So contract value is almost equal. One is giving for 20 lakhs purchase and this is 20 lakhs sell, because this has moved ahead. So by this process, we'll be having 169,000 of extra excess purchase. However, we cannot make it equal. So this thing we can do, we can purchase Bank Nifty and sell Nifty. So by this process, what happened? Our decoupling was high, so we have entered. Then the decoupling has to fall down to make profit. So after we initiate the decoupling gone up 3.30, it has happened, and suddenly what happened by this process on 21st July, the decoupling has slightly fallen. We have entered at 2.48, it has come down to 2.33. Very small correction happened. Very small deviations happened. So when it was increasing, our trade is at loss. But when this has started small correction from 2.48, just gone to 2.33. There is only 1.15% of recoupling happened. So that day, let us see what is the profit and loss it has given. So before that it was, so here I have taken, so 46,075. I have bought that thing at 44,745, 3 lots. It is Bank Nifty I am making 59,000 profit, and this Nifty I am making 30,000 loss. Net you can say 20,300 rupees profit I am making. So if you just see the earlier period, I will be making loss. One recoupling happens, I have made 20k profit. So this is how the beta decoupling works. Say end of month happened, say August is ending, what we'll do? We have taken a sum of the things. So now, so that particular one day action you have seen. But if you just sum it of all values till the 18th of August, it is giving 3.93. 3.93. Beta decoupling has expanded. So by this time, if you compare, you will be at a loss. However, this expansion of beta decoupling also is a threat to your trade. It is not recoupling. What you have to do, you have to wait. Suppose August ended, so what we will do, we will start from July, August and September will be just starting, but this carry we have to take. So whatever July we are going, so June we are taking off. So by this process, what is June data we are taking off. We are taking only July and August, but entire month of June there should be some decoupling will be there. This decoupling value what was there till 30th of June. So here it will go. There is a 1.37 carry. So this 1.37 carry also you have to take it to the next month. 1.37 carry, and whatever remaining comes for the July, August and September ongoing, that also will continue. So this process will continue if you are doing in the Excel sheet. So same process if you are comparing with the Bank Nifty with HDFC Bank, you can do in this order. So Bank Nifty and HDFC Bank both are having, you can say here, decoupling. If you just take it, net decoupling is negative 0.78. Earlier here you have seen positive. So Bank Nifty buy and Nifty sell. However, here negative. Negative means what will do? Positive case, I have told you, Bank Nifty purchase positive to above. It is, I told you, Bank Nifty purchase and Nifty sell. Here in Bank Nifty and HDFC Bank, you are getting negative. What should be your trade action? Can anyone will tell me? Negative -1. Though it is 0.78, slowly it can go to -1 also tomorrow. It may, after 2 days, it can go to -2 also. So if it is going to, this is my range, I should enter the trade. So here, who is independent? Bank Nifty. Who is dependent? HDFC Bank. So here, if I just ask you, if we are getting -1 to -2, then what will be your action? Which one you should buy and which one you should sell? HDFC should be bought and Bank Nifty should be sold. So this you have to remember. This you have to remember in this particular method. So if you are manually doing with the Excel, because I will show you in the that in our software also. So this is a process called beta decoupling. When decoupling goes to one threshold, you are saying that yes, you have moved ahead, you have moved far away, your demand is saturated now, so I will be selling you. So who has not moved? You can say his demand is not saturated, his supply is saturated, I will be buying. So in return, what you are doing? Hiddenly, mathematically, you are observing what the big players are doing. All FIs, mutual funds, what they are doing? They are not simply buying a stock and sleeping on that. They are not like our retail traders, those who are just buying and dreaming that tomorrow it will double up, day after tomorrow it will triple up. That is not, dreaming is not their job at all. The majority of the FIs or big players, what they do, they are following the accumulations and distribution patterns seriously. Which stock should go out of their portfolio and which stock should enter to their portfolio, that they are doing mathematically. They are finding out, yes, this is costly. Why? It has a higher Z score, it has a higher Jensen's alpha, it has a Sharpe ratio higher, it has a Trenner ratio higher, it has a Suttner ratio higher. So these are the parameters they are following. They are not counting the candles like you people are counting from the 9:15 to 3:30. This candle came, it broke, it happened, it flies. They are not in that job, my dear. So these are the things being followed by the large institutionals, those who are creating serious portfolio. They are making money for their clients. These are the techniques. Which stocks should go out of their portfolio or its weightage need to be reduced, and which stocks weightage need to be increased. That is a job done by the mutual funds and bigger players. They use serious complex mathematical models, And this is not a serious mathematical model, this is just a model to give you, yes, they are doing. So this can be converted to a serious mathematical model, so that I am not talking that it will make the sessions more complex. However, you have understood demand and supply mismatch. Mathematically, you can identify. No need to watch TV channels. No need to count this thing. You have seen that, and that is a proof. You can say whenever there is a beta decoupling goes above 2 and it recouples, it generates profit. When beta decoupling goes above +2 or -2 and again recouples, it has to recouple. There is no doubt about that. It has to recouple. Any decoupling happens, it has to recouple. There is no doubt about that. So here, this decoupling, once it happens, it has to recouple. So there, once the recoupling happens, it converts to profit. It creates alpha. So that is what you have to look for. So I have shown you in the Excel. So you can say Excel is cumbersome. I have to do all these calculations and then finally I have to derive quickly how I can make it. So those who are having our software called Smart IT. So many of you will be having our Smart IT solutions of Smart IT software. We have given this beta decoupling pair trade analyzer here. So if you are using this particular tool, you can very well analyze with just click of mouse. So there also you need not have to see that what beta decoupling is telling and what I should do. So this is how you can say this interface will be like this. If I'm going for index, so I'll be just putting that Nifty or Bank Nifty. Say I'm going for Bank Nifty, comparing with HDFC and Axis Bank. Both are banking stocks. 31st August is going to end. It has also intraday positional both. So say I'm going for September series. All three are September series. Same way, the way Excel data I have told, any carry it will take it and it will form of its own. So you can see click of mouse, just load and analyze we have done. So not only the beta decoupling, it has all ratios, whatever I have named, everything it has taken. Beta, alpha, Sharpe ratio, Jensen's ratio, Trenner ratio, correlation, everything it has taken. It has given you a study where they are standing, negative, negative, positive, HDFC and Axis, positive. Means HDFC Y first number and Axis Y next. HDFC is independent and Axis is dependent. HDFC having higher volatility as compared to the Axis. So that is what it is telling. That is what it is telling. HDFC Axis. So here what happens? So currently you can say that here, sorry, Axis is a higher volatility, HDFC this thing. So this pair, whenever you are forming, it gives a volatility. But Bank Nifty cannot be taken as a dependent even though it has a lower volatility because it is index. It is superior. So here, once you go for this study, what it says, Bank Nifty, one study suggests buy, four studies suggest sell, HDFC, four studies suggest buy, one is sell, and what it is sell telling here, you buy HDFC Bank in this range, hedge it with one put option of that strike. Bank Nifty also you sell, hedge it with a call option this strike, you can change the strike of your choice, exit the trade if it happens, and then the exit. So this particular complete analysis it gives. So 3 2 division views. So here you can say 5 and 5. 5 studies suggest buy Axis, 5 studies suggest sell Axis, 5 studies suggest buy HDFC Bank. So you can say beta decoupling also suggests Trenner ratios. So it is a perfect pair. These are the pairs known as your perfect pair. So here 5 studies has told. Yes, correlation is slight not favorable. The correlation is 37%, but you can counter that. If that is correlation is not favorable, you can hedge it. So here is you can say it is telling that buy HDFC Bank, hedge with the put options, and sell Axis, hedge it with the call options, and exit if they still decouples to a great extent, or if you can wait for that times, you can definitely, it can plus 2 has to come to 0, or plus 2 comes to 0.15 points, you can say 0.2, 0.13, 2.14, you can book the profit. So this is what it says. Intraday it also creates opportunities, but intraday always the pairs you will not get. Suppose if you are hunting for intraday, so I'm just selecting the intraday options, and here, so it will take whether the beta decoupling is expanding or contracting. If the beta decoupling is contracting or reducing slowly, that day intraday opportunity it creates. So just a click of mouse, it analyze everything. It is telling that trade is not recommended. Bank Nifty SDFC. Trade beta decoupling recommends buying HDFC and selling Bank Nifty. It has a morning analysis. You can say spread analysis not recommended. Beta decoupling recommends buying HDFC, selling Axis. So beta decoupling recommends the intraday trades in that. Correlations not recommends. Spread analysis recommends the trade. So if correlation doesn't recommend, we have to go with the hedging. If correlation also recommends, it is pretty good. All are recommending to enter that thing. So these are the tools you can just click of mouse, you can do it. So here I told how the internal works out. You have taken data, normalize the data, you have taken beta decoupling, past 3 months, whatever the beta decoupling is there, you are summing it off whether the decoupling is to sufficient enough to give you the profit or not, or it is creating any opportunity for you to enter a trade or not. So once you enter the trade, correlation is above 70%, no need to hedge. If it is not 70%, slightly less, you can hedge and go with the trade. That is what beta decoupling trade suggests. Any pair you can make. You have taken HDFC Bank Axis here. You can take a State Bank of India also here. SBI, and also you can take and load the data and see whether State Bank of India and Axis is creating anything. ICICI Bank also you can create a pair. Any related stocks. Do not create a pair between Reliance and ICICI Bank. Do not create a pair of SBI and Gujarat Ambuja Cement. Both are not related pairs. They are not into the same industry. Distribution accumulation has to be found out in the same industry, same business model. IT stock, if you are taking all three large cap IT stocks. So do not take Infosys and SBI. Both have no relationship at all. Both are, one is in the IT sector, another is in the banking sector. Mathematics, when if we are doing, do some ethical mathematics. So these are the basic things you have to take care. Other calculation the software will do, and it will sweep, it will bring which one independent, dependent, everything it will do, and it will tell whether the opportunity presents or not. So here it is saying that Bank Nifty SBI, the opportunity is not there for intraday trade. However, Bank Nifty SBI, if you see, the net decoupling is 3.34. Why it is telling that do not trade? Bank Nifty, State Bank of India, we have seen that there is a -2 or +2. We should enter a trade. It is telling -3.34, but it is telling do not trade. Why? Because though this beta decoupling is there, it is not recoupling today. Now it is end of market. I am saying today. If yesterday it is 3.34 and today morning when you are analyzing it is coming 3.30, so it will say that yes, the price action is suggesting beta decoupling is recoupling, and furthermore recoupling can happen, so you enter a trade. So if it is not recoupling, it will say that though decoupling is there, it is expanding. Do not enter the trade. So these are the finest thing which software can take care of. Then you need to hedge it. Without hedge, do not do this trade. So because you do not know how long this decoupling will continue, whether this decoupling which has started at 2 can go to 10 also. Started at -2 can go to -10 also. So for that you have to hedge it. And preferable hedging technique will, whenever you are buying a future, go with in the money options, buying a future in the money put option, selling a future in the money call option. So these are the ways you should hedge your trades. So this hedging also is important here. So as I said to you, look simple, execution very important, follow up very important, not suitable for intraday mindset people, because intraday mindset people never work for wealth building. I openly say this. Though yesterday I have told you 2 to 3 methods of intraday trading, but always I discourage intraday trade. Reason intraday traders are not wealth creators. They are only liquidity providers. Means they can only give liquidity to the market by volumes. They are not the wealth creators. Wealth they cannot create. And what is the intraday mindset? I'm too hurried, I'm too impatient, I'm too much troubled. I want that some quick money should come from the market and my fate and luck will change. That is called intraday mindset. That will never happen. Trades, not only trades, any activity which is having a hurried nature, you hurriedly drive a vehicle, you will definitely, there is a probability of 90% you will meet with accident. You do anything hurriedly, definitely you are going to meet with accident. So same time, when you fix your expectation first and work next, you will never get anything. So I want 1 crore salary and I will go for the job. So nobody will keep you, because they will, interviewer will say that no, this fellow is too greedy. What work he is going to do, he is not telling me, but he is asking that 1 crore salary first. So that is what is very important. Same logic happens here. These are the very high concept of trading, beta decoupling and Z score. It will test your patience. You will continue hedging, you will continue thinking, you will continue reciprocating. However, it will create wealth. It will create wealth. It will have a great power to create wealth. If the higher the volatility, these methods multiply your money very quickly. If the volatility in the market is too high, these methods can multiply your money like anything. When volatility is low, it will give you lesser return, nil return. Sometime month long you have to sit also without return. However, 1 month it comes to the volatility, quickly recoupling will happen, decoupling will happen, quickly recoupling happen. That process will continue very quickly. Within 1 or 2 days itself, it will change. So that is the period you will make huge money. And that capacity it has. So this is what the beta decoupling is. Then I will go to the Z score. Z score also similar type of study. It also goes with the same data normalization model. However, same +2 -2 +2 by dependent, -2 by independent. So this +2 -2 same concept is there. However, Z-score calculation is different. Same 10 days grouping of the data. So here we have to normalize the data first. So what is the normalization we have to follow? There is a formula for that. So that will normalize. So that formula also I have given you in the presentation. So here I have given you the formula how to data normalization to happen. So it will calculate for only one value it will take for Z-score. So we cannot able to take multiple values. So here what happens? We have to calculate a spread. So spread is nothing but this is how ln of the independent and minus dependent divided by the independent value plus natural logarithm of the dependent value. That is what spread. Why Nifty is fast and Bank Nifty next? Because Nifty is not a sectoral index. It is a common index. So it will be always independent. Here volatility has no role. anybody, if you are taking two stocks and comparing, there the market capitalization wise, whichever is higher, he will that stock will take as a independent, other will be dependent. However, if you take with the index will be always independent, all will be dependent. So this process also continues the same way, but this is a single day value, no summing of value. Earlier what we have been doing, we are adding the decoupling values. Here we are not adding the decoupling value. Every day it will be estimated and Z score will be estimated and kept. The day Z score gone +2, trade will be entered. So plus two means dependence time. Buying the bank nifty, you can say 28th January 2019, buying bank nifty, selling nifty. Whatever the lot size is there, based on that, equate the buy value and sell value. And here you can say just after 28th January 2019, it is entering to plus. Next 3 days it is coming to negative. So here the profit should be booked. Plus to minus migration, you should book the profit. Correlation pretty good, but still if you have to go for hedging, it is a great method. And I do trade in beta decoupling and Z score in very aggressively. I trade. So those who have joined my guided program earlier, they are still doing that trades. So what happens, it recouples within 3 days itself it has made. But 2019 volatility parameter was too high, so immediately there was a great change in the pricing, very quickly happens. You can say here bank nifty, what we have bought, so it is almost 40,000 rupees gain it is giving. So gain and profit, if I can say, bank nifty is bought, so here it is closed, so you can say bank nifty gives this profit. And how much loss the nifty is giving, so this is the nifty and this is the value. So nifty, how much it gives the loss, so 25,000. So once that recouples from 0.25 positive to negative 0.99, it gives near to 13,000 rupees profit. So same process, it is same process in a 16 lakhs worth of trade. Just by balancing that values, it gives you 13,000 profit. Again it goes to positive, negative. So this scenario continues. If you go on watching these values, it sometimes very quickly it resembles, sometimes it continue for a long period of time. So this part I maintained Excel, though software is there, but still I maintain in Excel so that I can keep a track of these particular happenings. So this is how the Z score also operates. And those who are using our software, we have given a pretty good tool here. You can say all stocks, all future stocks, stock future, because future only involved in this trade, all future stocks. If you just go to this particular tool, here we have also added very fantastic technical tools that also I'll tell you. So here this is a, we have given a scanner, it will scan and create a complete list of the stocks which is having what kind of Z score. You can say scan the stocks, all future stocks. With nifty it will scan. So we made it a nifty and all future stocks. So here you will be getting Z score. So wherever you will find, so here Axis Bank there is a negative Z score of 1.61. So here negative Z score of 1.61. Z score has versatile use. You can use it for short-term investment. You can use it for intraday trades. You can use it for the this kind of pair trade. So 1.613 negative Z score. So here who is independent? Nifty. Who is dependent? Bank Nifty. Sorry, Axis. So who is independent? Nifty. Who is dependent? Axis Bank. Negative Z score. So negative Z score, what it says? Negative Z score, buy the independent, sell the dependent. Negative Z score, buy independent, sell dependent. So who is the independent here? Independent is Nifty. Buy the Nifty, sell Axis. This is what it is saying. So this value as per the 21st August data. If you want to know 22nd August, the prices of Axis Bank is changing, Nifty also changing. Suppose if you want to know what is the Z score currently, just you have to double click on this symbol. Just take your mouse pointer, double click there, wait for a couple of seconds, it will tell this is 1.53, it was 1.61, it is now 1.5. Recoupling happens. So plenty of all stocks we have given. So now you can, so we have given plenty of stocks. So you can see plenty of stocks we have given, and you can now see how many trade opportunity it can create. Wherever that opportunity is there, Bharati Airtel negative, put your cursor here and find it out. So like this way, many opportunities you can get. If so many opportunities will be there that you cannot able to trade also. So that is what the this particular method says. That is what this particular method says. So here, this that is what the particular method says, and this particular method, Z-score method, is a very fantastic method, and aggressively we trade in that. Aggressively I take positions on that. These are the mathematical concepts. This will never be defied by the market. This cannot be overlooked by the demand and supply creators. This cannot be overruled by any majority sectional trader of the market. So anything happens, it has to reason, has to balance. It may take sometime 10 days, sometime 5 days, sometime few months, but whatever the Z score is imbalance is there, it has to rebalance. Whatever the beta decoupling value is there, it has to balance. It has to balance. There is no other way. It has to balance, because if that balancing act is not there, you must say that high confidently I am telling it has to balance. Why it should not go forever? It cannot happen. If that happens, then none of your mutual fund can exist. All will give you negative returns. None of your FIs can enter to your market. How can they dump one sector completely and go with other sector? How can they dump one particular stock in the bank index and go with other stocks? Is it possible? Bank index, Axis, ICICI Bank, SBI, all large cap banks you are comparing, you are saying that they will just have a love of one company and they will dump all other companies. It is impossible. This rebalancing and balancing act has to go on, and that is where when it creates that opportunity, you need to enter. When that balancing act happens, you need to book the profit, or the profit will automatically come to you. When this 3.9 positive of Nifty and Bank Nifty, what you are seeing here as a 3.93 beta decoupling, once is come to 0, you'll be at a great profit. Once it goes to -2, your profit is further going to expand. So yes, that may happen within 15 days, that may happen in 1 month, that may happen for within 3 months, but it will happen. It is not going to defy this rule. This rule has to be followed, and I have kept a track for that. So don't ask me that you show me from the track 2005 to till date, I will do it. Don't do it. I will not show you that proof. So 2005 to till date, if you want to do of your own, you can form a Excel sheet and do of your own. I have a track, but as you know, currently the regulatory frameworks never allows us to share it in public, to sell one product of 5,000 rupees or 2,000 rupees. I have told you what is the potentiality of this method. However, to sell that product of 5,000 rupees, if you want to that, you have to go through one very great Agni Pariksha and give me entire stuffs what you have from 2005 to till date. It is impossible. So I told you that mathematically it happens, it will happen, and this process, if it doesn't happen, the very existence of market also will be suspectable. So very existence of market also will be suspectable. So these methods try, so this particular workings also you have seen it here. How, what is beta decoupling? What is Z score? Beta decoupling is a summing up approach. Whatever the decoupling happens every day, we are summing it up. Z score is not summing up approach. It is just every day what happens. Based on that, we go for that. So these two studies only gives us what value? What is the demand and supply situation now? If someone tells me now currently majority of traders what they are doing, whether they are buying bank nifty and selling nifty or what, I will say they are buying the bank nifty and selling the nifty, because we are into the positive part of the Z score. Positive part of the Z score. Yes, sometimes this positive nature is continuing for the past 14 days. So if you hedge, the hedging cost will be more. Sometimes the hedging also can cause a loss. But this is situations what happens in low volatility market, you have to wait for longer time. Now you have some 8 to 9%, 10% volatility, you are waiting for more time. But when the volatility situation will change, you go to a 20%, 15% weeks or 15% weeks, that time it will be quickly multiply. Quickly it will change its demand supply situations and you will start making money quickly. That is what the potentiality of Z4 and potentiality of the beta decoupling method. So we have a very fantastic software for that. If you are interested, you can go that. Those who are having that software, they can use it. Those who do not have the software, they can use in the Excel based on the calculation what I have given. So you can use it. There is no stop for that you cannot use it. So beta decoupling, you understood. In my YouTube channel, I have explained the detailed formula how to calculate beta decouplings, everything. Just go through that video, make your Excel sheet and do that things. If you do not agreed to spend few thousands for your decision process, and if you are agreed to spend few thousands, you can get the software. Just click up mouse, all calculation comes and it gives you ready-made written statement, buy this, sell this, hedge this, everything. If you follow that, that itself is enough. So that part, that is the scope of this particular methods. So beta decoupling Z score is a very promising method, and I'll request all of you should use this kind of method instead of wasting your time on the intraday tossles. Use some scientific methods which has some value system in it, some concrete value system in it, some robust information or robust dynamic data dynamics in it. So that is what the beta decoupling and Z score stands for. So here also I told you that there are technical indicators also we have developed, which is our indicators. So what in smart finance, when I say it is our indicators, that time these indicators are being tuned or being changed with respect to volatility parameter to make it or enable them with discrete random data model. So discrete data, I have told yesterday, and these indicators we have made it discrete random model. So discrete random model, once we are making it, what you have to do, just load the data here. Values you won't get, definitely only 10 to 15 indicators we made it, and this product has a long way to go. So we have to enable many other indicators. So here, once you go for the analyze, how many moving average I have given here? Simple moving average, exponential, triangular, displaced. You may be knowing simple and exponential. Very few people know the triangular and displaced moving average. And there also another T series moving average also is going to come and add it here. Relative RSI, RMI, relative volatility index, stochastic, William, Bollinger band, all these things is there. Here Bollinger band also not static, 2% standard deviation. What is the standard deviation in that instrument that we have used? So it is telling based on the historic recommendation. What is historic recommendation? Evaluated as per the previous closing. So whatever happened on 21st August end, based on that, these indicators has given this recommendations. Out of all 10 indicators, 2 suggested for buying, 7 sell, 1 was neutral. However, today, current, once the market opens, it will change. This current situation will go on changing. 9:15 one value, 10 o'clock another value. So you can say that now 4 is telling to buy, but still majority are sell, 1 is neutral. So who are the studies telling to buy or sell? That also you can get it here. So by this process, if you follow these 10 indicators value also, your trades will be get refined. Displaced moving average, we are using the volatility into that. Exponential, simple as it is. Triangular, we are using a component of volatility into that. Bollinger Band, again standard deviation we have altered. Stochastic William and relative volatility index, there also we have altered and component of volatility is being added to it. So these are the ways, though we have a long journey to go and we have aimed to convert all the indicators and oscillators available in the market to random high frequency data model. There, so far discrete data model, we are going to change that mathematical computation to bring it to the random data model. So that will take some time, but that is a process of innovation which is in the hand of smart finance, which is on progress. So still whatever completed, that benefit should be passed on to you and you should start taking benefit out of that. So that is what our way of analyzing these things. And you can say Z-score based system. So pair trade means mostly you have non-price ratio. Divide X price by Y, there is a crossover, you enter the trade. That is known as fully pair trade method. I used to tell many of these pair trade methods, what they say, price division. If this is 19,396, this is 43. Take a division of this price with 19,396 and draw a line, this zigzag line. Here there is a fall, the ratio as this. Here there is a rise, ratio as this. So based on that, you create a ambiguous situation and with your own mind you take a trade. That neither studies the demand situation nor studies the supply situation, nor it says that where the supply is in concentrated zone or not, whether the demand is in concentrated zone, nothing it speaks, only price division, enter pair trade. This is known as fully pair trade method. This will give you 0% success. Keep it in writing. And many have attempted that and they have miserably failed in that trade. Miserably. They wiped out. Completely got for a wipeout situation. Price ratio method. So there, pair trade is a method. You need to understand its very definition. What is a pair trade? I have two companies. I am going to hedge A and B in such a way that whichever the company is having a saturated supply, I am going to buy that. That is what pair trade, saturated supply. No further supply will come, no further sale will come. So saturated supply company I will be buying, and whichever having the saturated demand will not go off here. Saturated demand, that company I will be selling. And both A and B from the one sector, or both will be having a interlinked index. So this is what called your pair trade. Pair trade no way says about price ratio. Price ratio can change. Internal arithmetic can change that, but these distribution and supply arithmetic will not change. Any banking mutual fund cannot dump SBI and buy only ICICI HDFC. Any banking sector mutual fund cannot dump. Yes, certain cases like SB, Yes Bank like of case comes, they may go for that. However, there are remote possibility of dumping those stocks if the management is doing good or as long as the business are competitive in nature. So same process, beta decoupling. Stock which has moved 2 steps or 3 steps ahead or run little faster, it has to wait there. You both friends are walking in a park. You have walked a little faster. After some steps, you are saying that let my friend come and join me. You are waiting there. So beta decoupling is that things. It is competitiveness. There are two competitive stocks are there. One has moved ahead, it has to wait. Other has to come and join him. That is how your stock market works. Demand supply only drives the market. Demand supply liquidity. So demand supply and liquidity. DSL, demand supply and liquidity are the three driving force of your market. Market never been driven by our imaginations. Market is never been driven by the TV commentaries. Market is never being driven by the people who are having a very lesser money. Market is being driven by the fat pockets. Pocket which has fat in nature, having higher money to play. So they go with the accumulation distributions channels, which stock they have to choose, because every time they have to buy something, they have to exit something. What process they will follow? Whether they will look at the screen and candles and jump in with like us? No, they cannot do that. They're not supposed to do that. Then what they are following? They are following much advanced mathematical model. These are very small models. You have certain ratio, you have integrating model, many sophisticated mathematical model drives there. However, yes, we retail players cannot take to that extent because the capital is not that much. However, we can take this benefit. We can let them eat the flesh, but bone will be left for us. So like this way, we can find out what is the demand, which stock is in the demand and supply zone, has moved ahead, who is going to wait and which other one is going to catch up the trend. So that we are going to find out through Z score, beta decoupling and all, and that is going to give us the profit. So that is what this method promises. And believe me, those who are following this method from 2005, beta decoupling, no one got disappointed. Those who are following this Z-score method from 2020, they are not got disappointed. I have not got disappointed. How they can go disappointed? So that is what it gives the promise. However, it is look simple. Implementation is difficult. As I said to you, you have to hedge again those buying and selling trades with the options, that to ITM options. You have to look at the time value in these ITM options. Again, further when opportunity comes, you have to sell and take out that time value. You have to harvest that time value. You have to go for the time value harvesting. You have to go with the profit capping. All these techniques you have to follow to make it more tech oriented and make it more profit oriented. Simply it speaks out 1.94, I will initiate the trade and sleep in my house. After 10 days it will become zero, I will make things. Yes, that also will give you success, but that also will give you failure. So you can say 1.94, I will initiate here, then I will not do any profit capping, no hedging, wedging, nothing. I will simply say, let the demand supply to go to the minus 1.94, I will make the profit. Yes, you will make that time also. But there, error of approximation also will be there. You can say that 70% you will make a profit, 30% failure you will be there. So you can land in the losses also. So that is because you are not doing any management there. Simply you initiated and forget. Just like you have an open field, you plow it and put some paddy seeds. The paddy plant has come, no fertilizer, no de-weeding, nothing you did. Simply you have plow and put some seeds and you are waiting that heavy harvest will come. No, harvest will come. That harvest will not be an optimized harvest, little harvest you get. So person who has done little more work, he entered, then he has done the weeding of the field, put it, managed the humidity, the soil levels, waters, taken care of that field, his harvest will be bumper car. So here, same process you have to follow. You need to enter, you need to hedge it with the ITM option. When the bridging happening, you have to book profit, move the thing. Sometime time value you have to sacrifice, sometime time value you have to take it out. So some amount of activity will go on doing that process, migration from plus 1.94 to minus 1.94. You'll be going on doing small harvesting, plowing, de-weeding. So that process, I can say, profit capping, time value harvesting, intrinsic value harvesting, all this process, if you keep on continuing, your harvest will be very good. And if you follow this method sincerely, it has the potentiality to double the money in very shortest period of time. I will not tell you that period. Very shortest period of time, it can double of your capital. That potentiality it has. If it has that potentiality, it should be duly taken care. So that due care should be taken for that trade. So for that trade, this trade has that potentiality, and that potentiality is enormous potentiality. So this is what the beta decoupling and Z score stands for. So keep studying it and keep using it. If it is a easy thing, then it is intraday volatility method, very easy. 100 bucks you will get, 200 bucks you will get. But this is having the potential to double your money, means it has that difficulty should be there. It should not be so easy. Though it looks easy, but implementation is very difficult. You have to hedge, you have to manage, you have to switch. Lot of activities involved. That's why I told you are just like a farmer. You have to plow your field, you have to put the seeds, you have to de-weed that things again. De-weeding means again fertilizer, water, everything. You have to continuous crop cycle. You are watching that. Then only you will get a harvest, bumper harvest. For bumper harvest, you have to continuously watch the field. You have to continuously involve yourself in that field. Then you will get a bumper harvest. So that this method has that potentiality. So it requires your engagement. What kind of engagement? Not a very hard work. But it works. You hedge me. If you have hedged me, you harvest the time value time to time. If you have harvested the time value time to time, sometime you try to harvest the intrinsic value time to time. That is what that method demands. So two three ways, if you keep on harvesting, so I am healthy. So when the situation is favorable, I will give you bumper profit. That is what this method promises you. But if you do not involve yourself, yes, you will get. It is just like that. You plow the field and throw the seed, and then after do not look at the field. So that harvest only you will get peanut. Sometime not. Sometime peanut. Sometime not. Also you will get. Not means zero. Sometime zero not means negative. Also will come. Not loss proof. Not 100% loss proof. Keep it in mind. It will give you losses also if you do not take care. So it requires also, it has to be taken care of. If you have my book on futures and options, Master's Key to Futures and Options, you can uh, read the hedge ratio and other things. So this is an entirely independent method. It has no dependency on anything. It is a summing of the beta decoupling values. When the opportunity creates, you enter. If opportunity doesn't create, you have to wait. Package 5900 package, you get this 1SD and GAN software. So this doesn't, and it you get GAN course. These three things. It doesn't have beta decoupling. It has zero Z score, nothing. If you go with this particular software, so you get beta decoupling and Z score, though both the software. This software also comes with that, but GAN doesn't comes with that. So if you are going with the all softwares, then you get everything, whatever we have. So based on your choice, if your choice is only for intraday, then why you will dump all these higher concepts? Simply you go with the intraday type of products. So If your choice is for options strategy, you can go with the option strategy product. If your choice is for the higher end beta decoupling, jet score, all those monitoring things, you can go with the smart IT software, all the entire software package. So that is based on your choice. And in fact, we have reduced the prices. It was very high, means you can say double the prices was there. So we have moved to certain specific Indian server. So our cost of deployment also has come down. We pass on that cost to the buyers. So by this process, just few days back, we have reduced the prices by 50 to 60%. What is difficult? I'm not making any money. I'm not ready to learn anything to make money. I am not ready to change my trading habits. I'm not ready to change my trade to a blissful trade, to a simple trade, to a happy trade that I do not want to do. That is difficult. So that's why this easy concept also will look difficult. You are not going to do any calculation here. Make it blissful, make it happy trades. So that is what I used to tell in our smart finance logo, or the beginning, what we said, stock market made easy. If it is easy, how can it will be difficult? That is our logo here. Gamblers, 99% of your day traders accepted that market is only for gamblers, because they have never made wealth, they cannot make wealth, so they have that negative feelings has gone. Only way is gambling. So how gambling? No concept, no mathematics, nothing. At least if they follow volatility method, they will be spared. That also they want to. Their thinking is only TV channel can guide us. 10 years on TV channel, they say 20 years, 15 years I am trading in the market, I have not made any 1 rupee. Why you have not made any 1 rupee? 15 years you have worked in market, not even 1 rupee. Why? No, sir, only loss, 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 but I am 15-year experienced. What is the use? Because that happens only in the money business. Money never stops you. Money never dictates you. You are the owner of that money. You can do anything with the money which is in your wallet. You can spoil, you can grow. So that intensity doesn't allow them to learn anything. That makes every part of the job is difficult. If one dog is chasing you, can you say that it is difficult for me to run? Can anyone will say? If you are walking in a road, one dog is chasing you from the backside. You are telling that no, I am 120 kilo weight, I cannot run. How many of you will tell I cannot run? You will run. I will give you guarantee that you will run. When it is on threat in your life, you will run. So if you are going to run that time, what is the difficulty in this? Free calculation is difficult. Calculating beta, complex formula, covariance variance into 10 divided by 9, it is complex. Calculating decoupling, this is going to happen, happened something different, how much extra happened, how much less happened, this calculation is difficult. Or correlation in 10 days data, it is difficult. Or adding all this data is difficult. No, nothing is difficult other than addition, subtraction, multiplication. What I used? Nothing. So that is what is the fact here. So well, nothing is difficult here. You just start learning from the web resource, free resource. If you do not have our course also, you will think that yes, it is easy. Once you start implementing, so I have given you from here June to here. If you have excels, you can make. I will not give you excel. So if you have excel, you can make it and find. Here I am buying, here I am closing, this much profit came, here I buy, sell, close, this profit came. So profit loss, that you can able to calculate and see that. Scientifically, this method works on scientific basis. It has evidence, it has a basis, it has a ground where it is standing. Like a sincere farmer, it demands what? You plow the field, you plant the seed, you take care of me. then I will grow and give you the money. That is what it demands from you. It demands you plow the field, see the opportunity here. This seed is going to grow. This trade is going to become successful. Buying Bank Nifty, selling Nifty is going to give you success because it has 3.93 beta decoupling. It is going to give you success. You have planted the correct seed. You have taken a correct decision to enter this trade of buying Bank Nifty, selling Nifty. It is telling, please take care of me. What? Take care, hedge both of them. That is the first care. First care, hedge. Second care, once the price will move, price will not sit in one place. Price will move, but beta decoupling is not recoupling. It is still 3.93. It is going to 4, 5, 6, anything. But price is going to change. So whatever hedging ITMs are there, harvest intrinsic gains, harvest time gains. Sometimes you like to sell some option. So you keep on engaged with me. It is telling you keep on getting engaged with me, keep your engagement on, and wait for me to give you reward. So you planted correct seed, you have engaged, it has become zero, you harvested a bumper crop. That is what it requires. Nothing, no rocket science, no hard stuff. I'll be taking how you can make zero loss option strategy model and how you can project monthly top and bottom. Good night to all of you. Thank you very much. Thank you for your time.